Hello, hello, hello. Good morning to you this morning. It's another amazing Friday morning. My name is Ayodele-Bamisaiye, Dexteritas Professional Corporation. Today is Friday, the 21st of November, 2025. Wow, come a real long way. 52 weeks almost counted down. It's been an amazing year so far. Great experiences, great learnings, opportunities, all sorts of good things. And this is Finance Friday. This year, I've spent most of it talking about tax planning because I believe that tax planning is that important. And I have another interesting subject to talk about on the matter. But before we go into that, as usual, I want to bring to attention of every one of the modest income persuasion who may, for whatsoever reason, have unfiled tax returns that are due to the Canada Revenue Agency. Well, my friends at the Financial Empowerment Initiative are excited to support you to have those tax returns filed as soon as you are available to book an appointment. So, how do you get to do that? Send an email to operations@thefei.ca and somebody will get you an appointment and schedule that appointment so that you can have your tax returns prepared and filed, and so that you can access all the benefits that are available to you from the government of Canada. So that's one thing that I would like you to know. Now, number two, yesterday was Founders Lounge. Ha 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 ha. That was fun. That was fun. We had an interesting twist on at Founders Lounge by Startup Court last night, and we were not really talking core business, but we were talking about business. We spent time talking about wins and losses and what we are learning, and it was a very interesting conversation. There were some high points, some very spirited, discussions, and ideas were shared, lessons were learned. But I think we're all better prepared to go into 2026 with that session behind us. But that was a really good one. I really enjoyed it. Shout out to Dozie Ayebonam of the Newcomers podcast, who was our moderator yesterday. And as a show of support for him, I'm wearing the Newcomers t-shirt. Now, this is part of a campaign being put together by the Newcomers to support Canadian Immigrant Women's Society. Yeah, that's SIWA. It's the same SIWA. They've gone national now. And he's selling 1,000 of these t-shirts to support SIWA in their mission to help immigrant women better integrate into Canada. So I'm showing support for him. And you can show support for him too. Just go to the Newcomers website and find out the instructions on how you can pick up one of these. So I think that's what I have as far as gist is concerned. Let's get into the meat of today's matter. For today, I'm going to be talking about capital gains and losses. Capital gains and losses, what's that? Okay, so every time you buy an asset or sell an asset, there is a tax implication. Whether that asset is a business, shares of a corporation, shares on traded or not, whether they are traded or not traded, whether it's a real property, a house that you live in, a house, an investment property, any kind of asset. When you trade in an asset, there is a tax implication. Now, when the asset we're talking about is a house that you live in, the tax implication is muted. And that's because there's something called the principal residence exemption that allows you to keep up to $1 million in capital gains arising from a home that you own, that you live in, right? So that's one thing to know. But the point I'm making it to you today is that every time an asset changes ownership, either by reason of an actual sale when cash is exchanged, or by reason of a deemed sale, some kind of change of ownership, there is a tax implication. And the essence of today's session is to draw your attention to that tax implication. Now, if you have non-registered investments, i.e., you have a Wealth Simple account that's not an RRSP, it's not a TFSA, it's not an RDSP, it's not on any of the registered CRA programs, this could be one of the most valuable sessions that you listen to all year. Now, why are capital gains and losses important? Why do you need to understand how they are created, how they work, and how they impact you? Because capital gains are taxable, but capital losses are not deductible, at least not against other sources of revenue. So it's very important because that suddenly creates a quirk. For business income, if you lose money, you get a benefit. You get to recoup that loss against other types of income. However, for capital losses, you cannot recoup them. Once you have a capital loss, you can only recoup it against a capital gain, right? Now, those losses that you see and you're like, wow, I've lost all this money on the stock market, or that kind of situation, those losses could create a tax advantage for you if you know how to set yourself up. Now, please note, only realized losses and gains count. What does realized mean? That means that you have sold the asset and the loss is real. It's not the market has gone from $5 to $1, so I have a loss. Or the market has gone from $1 to $5, so I have a gain. No, it means that you bought it at $1, you sold it at $5, and you've gotten the cash. The asset is no longer yours. The capital gain or loss is created at the point of the sale, at the point of the transaction. So if there's no sale, if there's no disposal, real or deemed, if there's no change of ownership, real or deemed, there is no capital gain or loss. So if you are looking at your investment portfolio and it seems that the graphs are all red, it doesn't matter until you sell it. If you don't sell it, then there's no capital gain, there's no capital loss. Only this year's losses can offset this year's gains. Yes. So you need to think about that, because Q4 is a time when you get to rebalance your portfolio and say, okay, have I made money in places? Have I lost money in places? How do I balance my portfolio to ensure that it's taking me towards my investment goals? Sometimes those goals require you to sell assets that are doing well because you need cash. Sometimes those goals require you to sell assets that are not doing well because, well, it doesn't look like they're ever going to recover, and you just want to recoup the value that's left in them. So just an FYI. Now, only 50% of capital gains are taxable. Just for you to know, only 50% as of now, as of today. I know there was some legislation in the immediate past that was moving that number to 66, 67%. However, as of today, only 50% of capital gains are taxable. So, using my $5 example, you bought a piece of share or piece of stock for $1, and then sometime later you sold it for $5. That is a $4 capital gain. Only $2 of that $4 is taxable, and it will be taxed at your marginal tax rate. Now, how do you determine a gain? When you sell for more than you buy. Now, you are always going to hear the term ACB, or accumulated cost, adjusted cost base, when we are talking about capital gains and losses. And your adjusted cost base is simply how much it costs you to acquire the asset whenever you acquired it. So in this example, it cost us $1 to acquire the asset. We sold the asset for $5, resulting in $4 in capital gains, of which $2 is taxable. That's 4 times 50%. Now, if there's no sale, there's no tax. End of story. I know I've said that before, just drawing attention to it again. Sometimes choosing to hold on or defer a sale or to sell early can create a tax advantage. That's why you need to revisit your portfolio and make sure that you understand what's going on and you are able to clearly identify where the gains are, where the losses are, and where the opportunities to create a tax advantage may exist. Note, losses offset against current capital gains. That's number one about capital losses. Number two, losses can be carried back 3 years, and the best part, losses can be carried forward indefinitely. So even though you cannot recoup your losses against other types of income, you can recoup your losses against future capital gains. That is an opportunity, and that is what is called tax loss harvesting. Thank you. Now, what are the things you want to do as an investor at the end of the year? You're looking at your portfolio and you're asking yourself, okay, where are the losses that I believe that I have no choice than to lock in right away? Then you're looking at your gains to say, okay, where are the gains that are taxable for me? And you're looking at how to manage those such that your tax bill is not a number that hurts you as a result of having a decent investment portfolio. Now, also you are looking at the tax losses and saying, okay, are there historical gains that I've reported in the past that I can take these losses back to go and defray so that I can save on some of that historical tax bill, because that is something you can do. Now, there are some investments that it may be beneficial to say, okay, you know what, I'm not selling that this year, I'm holding on to it from a strictly tax perspective, and then you'll be making the sale in January rather than in December, because it creates a tax advantage for you. The most important thing in all of this is being aware of the advantage and taking it when it is there. Now, lastly, I had mentioned something in week 7 about donating securities. So if you look at your portfolio and you see that there's going to be a benefit to you, right, making a donation of actual securities, right, or you want to make a donation, one way to do it is to use actual securities from your portfolio. And you do not have to sell the securities. You can transfer the securities to the organization you'd like to give the securities to, and then they will issue you a tax receipt for the full amount. That saves you all the transaction charges, and that ensures that you get the best bang for your buck as far as your charitable giving is concerned. So, capital gains and losses are powerful tools. They can make a real difference for you, but you need to understand how they work and how you can use them to your advantage when you have stocks and other such assets as part of your portfolio. They can be powerful tools for saving on your tax bill, right? So if you're unsure and you're like, I really don't know what Dotun is talking about. Dotun is here and he's talking all this capital gain, capital loss thing. Well, you can hit me up, talk to me.dexteritas.ca. I'm available. Book an appointment. Let's have a chit chat and see how I can provide more information to help you make better decisions as far as your tax plan for 2025 is concerned. The year's wrapping up. This is week 8 of this 11-week series. I'm winding down talking tax planning for this year with this series. Last week we had talked about charitable giving. This week we've talked about capital gains and losses and how you can use them to your advantage. Next week we're going to be talking about documentation, because guess what? When it comes to the CRA, anything is auditable, and the only way to survive an audit is to get the documentation right. I'll be here this time next week to have that conversation, and I am looking forward to it. It's a beautiful Friday morning. Yeah, the sun's not shining as brightly as it used to a couple weeks back, but guess what? The sun's shining in here all the same. So have an excellent day, and bye for now.